We expect 2018 to be not as unidirectional or stable as it was in 2017 from a macroeconomic perspective. For example, some of the tailwinds that India enjoyed as an economy getting a little more challenging. For example, commodity prices have been going up, especially oil, and inflation has been a bit inching up, and on the back of that, we have also seen interest rates move up in the last 3 months. Fiscal deficit is beginning to create some bit of a concern in the marketplace. Globally also, we think that as the growth accelerates, the rates are beginning to harden across the countries, and with central banks paying more attention to the balance sheet size and have taken steps to shrink the size of the balance sheets, we think perhaps in the second half of 2018, we would see some volatility in the marketplace, and I think therefore 2018 is going to be a lot more eventful than 2017. Domestically also, the country is going to face few elections. States of Madhya Pradesh, Rajasthan and Karnataka will have elections during the year, and this will again set the undertone, political undertone, as well as some kind of a policy initiatives will be taken in the run-up as well as the post-elections, which we think will become some of the shaping events that happen in 2018. We have seen a significant run-up in the mid and small cap stocks during year 2016 and 17. I think investors need to be aware that while fundamentals are improving for corporate India, the liquidity has played a little bit elaborate role in the valuation expansion of this segment. So we as a fund house have been advising a bit of a caution in terms of significantly allocating incremental investments towards the mid and small cap. That is one risk we would like to flag for investors. Second is there has been a tendency to play shorter term trends through either directly through stocks or joining some portfolio schemes with a very significant risk-taking behavior. We think as the markets go to higher levels, people should take more prudent risks, not more exaggerated risks. So from an allocation perspective, investors need to be fairly conscious to rebalance their allocations in line with their long-term asset allocation goals, so that any skew that happens because of market movements kind of gets rectified during this rebalancing. Markets have run up over the last 1 year in anticipation of good earnings recovery, and we have fairly good signals that earnings over the next 4 quarters going to be much better than the earnings growth that we have witnessed in the previous 4 or 8 quarters. The consensus expectations is the earnings growth will be in mid-teens over the next 4 quarters. A combination of base effect, recovering growth, expansion of margins are going to help in achieving this mid-teens kind of growth rate. So from a earnings growth perspective, markets will be reasonably okay over the next few quarters. But where we see the risk emanating is pockets of overvaluation. Over the last few years, markets have tended to kind of reward companies that deliver growth and punish companies that have been disappointing on growth in an excessive manner, which means companies that have been meeting expectations have gone through a fairly large re-rating process, and companies that have disappointed expectations have gone through a de-rating process. So we have seen some kind of a widening of valuation gap between these two kinds of companies, and that creates a kind of a market polarization effect. And incrementally, we think that more value, or people should be aware that there may be deeper value in companies that are more moderate growth than companies that are delivering fairly attractive growth. So while valuations are polarized, opportunities do exist in the marketplace in terms of good investable ideas or sectors.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.